What are we monitoring? This year, one of the most important things that the government has said clearly that they want to be focused on is to ensure that the fiscal deficit reduces from 4.9 to 4.7. And they also want to be increasing their spends on rural, giving out SOPs, which effectively means the Capex is going to take a hit. So effectively, if Capex is going to take a hit, certain sectors may have a slowdown post the budget. That is something that we want to be monitoring. So where we are positioning there and becomes important. I don't think that this is structural. I think this is more of a calendar year 25-26 phenomenon, after which the base effect will take over. So if we see volatility there, you will see us adding more risk into those spaces. Finally, the way I wanted to just give you a perspective is at ITIS over the last 3.5 years, we've been significantly investing in technology in terms of how research gets to work with data. And this has helped us in terms of granularly positioning portfolios from time to time and risk managing them with efficiency over time. So I thought we'll take up 3 to 4 positions of ours and give a perspective more from an outside-in view around what are some of the data points that we look at within the firm. So one position within the Capex space that could be a beneficiary from a slightly more medium-term perspective is our position on KAI Industries. KAI Industries continues to be the second largest player in cables and wires today from a market share perspective, but the largest player in terms of exports. So as Capex from both the government and private sector increases, you are going to see power transmission Capex translate into ancillary businesses like cables and wires grow significantly. Now, one other interesting trend that India has transitioned is in the cables and wires segment, we've become a net exporter of goods and services. Pre-calendar year 18, we used to run a deficit. And KAI Industries has been a beneficiary of this because roughly around 13 to 13.5% of its revenues come from the exports. And we see this power transmission theme not just as an India-specific theme. We see that US also becoming significantly spending a lot on power Capex. So transmission in terms of export revenue should increase for the company. Second company that we want to pick up is ICICI Lombard. Again, this has been a position of ours in the last 1.5, 2 years, and which has done well. We continue to own this. We have not trimmed weight in this. One aspect that we monitor for companies that we like, that we want to be owning structurally, is how their market share grows. So market share growth is obviously a function of either your distribution increasing or your product increasing, or you have some kind of technology-led initiative. And what you would see in the general insurance space is while many players have come and gone, ICICI Lombard has, while they might have sacrificed growth on certain years, they have ensured that their combined ratio has always been kind of best in class. And that has resulted in significant and continuous market share growth over time. And this market share growth and all of this effectively comes from our tech-led platform. So the way effectively that we as analysts work is there is always a human-machine interaction. All the machine in terms of data comes from the technology side. And then the human element comes in terms of interpretation and verifying things on the ground. What we continue to monitor is from a competitor analysis perspective, how well are insurers writing? So if you just reduce growth without or rather sacrificing on how well on the quality of growth, those are kind of businesses we would not want to be investing in. So growth at any price or growth at any cost is not a sustainable way of growth. And we want businesses who may sacrifice growth over a few quarters, but who will not sacrifice margins in the quality of growth. The third segment, like I said, while we may have trimmed our exposure in auto four-wheeler or exited all of our auto ancillary position in the year, two-wheelers is a space that we structurally continue to believe should do well, because after a period of 11 years where two-wheeler growth was roughly 3.5%, you're actually seeing volume growth come back in a structural way. You are seeing this growth both in the 125, sub 125, as well as the premium segment of the motorcycle vehicle. And specifically, if you look at urban registrations, and this is something that we again pick up both on a monthly and quarterly basis, you have seen structural growth in terms of volume. So going bottom up and seeing who are those players who have pricing power along with an inflationary effect of volume growth picking up are those companies that should benefit both from a margin and volume perspective. And that's the exposure that you would see in our portfolio.